Are you ready to have your mind blown by some eye-opening statistics about investing? Maybe I'm building this up a little too much, but these numbers are pretty cool. I'm going to show you 9 surprising facts that will change the way that you approach your investments. From how to lose $1 million as an average investor to why some of you watching this are going to end up with less money than you think, to how you can make a few simple changes to have more than double the amount of money that you originally planned for. These stats are going to shock you and hopefully inspire you to rethink your investment strategy. So take a quick sip of water, do 10 push-ups, and let's get started. To prevent myself from having to repeat myself and annoy you when I touch on each fact, here is my blanket disclaimer. The past does not dictate how things will play out in the future. But my dog Molly will be just as cute in the future as she is today, so hit that thumbs up button to help support her. A scorecard is done every year to compare actively managed funds versus index funds, and every single year it doesn't look good for actively managed funds. Over 20 years, 90% of US stock-based actively managed funds underperform their comparable index fund. To make it worse, only 30% of actively managed funds survive over that time period. The other 70% performed so poorly that they had to shut down the fund. International funds aren't any better. Over 20 years, 90% of actively managed funds underperformed their comparable index fund. Only 32% of actively managed funds survived over that time period. The other 68% were so bad at what they did that everyone stopped inviting them to birthday parties. Actively managed bond funds are even worse. Over 15 years, 98% underperformed their comparable index fund. To top it off, only 46% of those actively managed funds survived over that time period. The other 54% had to shut down in hopes that everyone would just forget they even existed. The takeaway? You would never continue being a customer of a business where there was a 90% chance that they would mess up your order. So can we just stop wasting our time with anything other than index funds or ETF-based index funds? I'll have videos for everything you need to know about investing this way down in the description below. Most people are getting raises every year or couple of years. For those of you who don't, this is an issue that needs addressed as soon as possible. Whenever you receive one, always use them to your advantage. Sure, spend some of it on things to improve your life once that bad debt is paid off, but take the majority of it and increase your investment contributions. If you make $70,000 per year, the difference between contributing 4% versus working up to contributing 10% of your salary is the difference between having $481,000 versus $1.2 million after 35 years. It's a good reminder that we all have the opportunity to be millionaires if we'd like. Did you know that the average lifespan of companies in the S&P 500 is only 18 years? This is why I laugh when people tell me they buy the largest stocks in the S&P 500 like Apple, Microsoft, and Amazon because they're quote-unquote safe. Yes, they're safe right now, but those companies will shrink one day, so you better have an exit plan or just buy index funds and move on with your life. Look, I don't like to play favorites because I love all of the data that I've shown you so far. But my favorite one is this spreadsheet that I put together for the S&P 500 going back 97 years. Here are some interesting and not so obvious things that every investor needs to know. Thanks to FlexiSpot for sponsoring this video. I've been using standing desks either at work or in my home office since 2018, and I can tell you that their Pro Plus E7 standing desk is the best one that I've ever used. It's extremely stable since it's built with a solid carbon steel frame. I personally prefer a more minimal setup, but since the E7 can hold up to 355 pounds, it's perfect for a work from home environment to a hardcore gaming setup. My dog Molly startles pretty easily, and the E7 is so quiet that she doesn't even notice when I adjust it up and down. Since the height can be adjusted from a little over 22 inches up to more than 48 inches, it is perfect for anyone well above 6 feet tall, all the way down to someone shorter than my little 5-year-old niece. Stability is very important when it comes to a standing desk that can go up to 48 inches because you don't want it wobbling around while you work. The E7 has no issues with this unless it's being shaken really hard, which very rarely happens. FlexiSpot also offers the E7 in a wide range of sizes, colors, and materials to suit your personal style, match the colors of your room, and fit the space that you want to put it in. The E7's LCD LCD keypad panel takes this desk to a whole nother level. There's a USB port on the side so that I can charge my cell phone while I work, and with 2 taps, you can preset up to 4 different height settings to meet whatever needs that you have. Now I have 2 desks, but I bought my first FlexiSpot standing desk 5 months ago and instantly fell in love with it. So when they reached out to work with me, it was a no-brainer. Do not waste your time or money with any other brand. Use the link in the description down below to pick up your FlexiSpot E7 desk and make sure to let them know that I sent you. One of the biggest financial crimes that I see on a regular basis is when people expect an average annual return of 12% going forward. These people who are telling you this need to be arrested and thrown in jail immediately. Let me show you why. Look, I understand how they came up with this number, so maybe instead of putting them in jail, let's just make them sit in the corner for a couple of days to make them think about what they did. They get this number by looking at the average annual returns since 1926. Doing that comes out to 12%, which is why they base their future returns on 12%. But the first problem is inflation. Cool, you can tell me how much I'll have in future dollars by using 12%, but that number is irrelevant if I can't quantify how much that actually is in today's terms. I can barely quantify what my life is going to look like next week, let alone 30 years from now. We should instead look at this number after inflation. I know that number won't look as big and sexy as 12%, but at least it's a little bit more honest and easier for us to understand how much we'll actually have in the future based on today's dollars. The second problem that I have with this 12% is the fact that it's over a 97-year period. Newsflash, but 99% of people aren't investing for 97 years. I think a better way to measure this is in rolling periods based on time frames most of us will be investing for. So I put together rolling averages for time frames of 5, 10, 15, 20, and 30-year periods adjusted for inflation, going all the way back to 1926. Here are the average returns for all of those rolling periods. It's wild how they all end up pretty darn close to each other. If you're someone who is using the past to project your future returns, around 8% would probably be a more realistic number to use as opposed to 12%. When projecting my future returns, I personally like to be a little bit more conservative and go a little bit lower than 8% just in case I end up on the wrong side of luck, which I will show you what the wrong side of luck looks like in just a minute. These average annual returns can be a little misleading though, especially when we're talking about shorter time periods like 1, 5, and 10 years. Even though the averages for each was 8%, when we dig into the details a little more, we see that there were time periods of investing where you ended up with a negative return. As you can see for the 1-year returns, there's a little mixture between up years and down years. Since 1926, there are 97 1-year periods. Of those 97 years, you ended with a negative return during 22 of them. When we zoom out to 5-year rolling periods over the past 97 years, the story starts to change a little bit. There are 93 5-year rolling periods since 1926. During those time periods, you would have ended with a negative return for 16 of them. Moving out to 10-year rolling periods, we see that there have been 88 10-year rolling periods since 1926. You would have ended up with a negative return during 8 of those time periods. If I can fit them all on screen together, I'm going to put up the 15, 20, and 30-year rolling periods because as you can see, you would have never ended any of them with a negative return. This is just another case for why investing for the long term is extremely important. And by long term, I'm not talking 5 or 10 years. We're talking about 15 plus years. Also keep in mind that these numbers are only for people who invested in the S&P 500. If you were out there messing around with actively managed funds or tilting your portfolio in other directions that underperformed, then your returns would have been a lot lower. Refer back to the first point of this video where the majority of actively managed funds underperform its index fund benchmark. Something else to be mindful of when investing that is very, very rarely talked about is the fact that timing is everything and a lot of the outcome is out of your control. This is the whole luck factor, which is why I personally project a return that is less than the historical 8% per year. Here's what I mean. You can be a very responsible responsible investor who is investing for 20 years starting today, and your returns could be much higher or lower than the average person who is investing for 20 years starting in a different year. Check this out. Here are the inflation-adjusted returns for 24 different 20-year rolling periods. If you happen to be investing during this 20-year rolling period, then your average annual returns would have been 9.46%. But if I had started investing during a 20-year time period that started 4 years later, then my average annual returns would have only been 5%. You would have beaten me by 4.5% just because of the randomness, timing, and luck that is life. Maybe I just happened to be born 4 years after you because my parents didn't want to have children until they were financially stable. And maybe I didn't start until 4 years later because I was only making responsible life decisions. Life is so stinking random and out of your control. You could be doing all of the right things in life, but because you just happen to invest a few years earlier or later, your returns are a lot lower than someone else. I'm not telling you this or showing you this to discourage you from investing. I'm showing you this because it's one of the least talked about topics in investing that is extremely important to understand. It's also why I promote investing as much money as possible, because even if you are that one unlucky person who gets lower returns even after doing the right thing, at least you made up for those lower returns by investing a larger chunk of money. And if you happen to be one of the lucky ones who invests at a time period where returns are above average, then you can reduce how much you are investing as you get closer to retirement. While you're crying because you invested too much money, you can wipe away those tears with all of that extra money that you have. Boo-hoo, you invested too much money. So you have too much money. Such a sad thing. Our human brains are just not cut out to be patient. As an investor, patience is one of the most powerful qualities that we all can have, because the better we become at it, the more our money can grow through compound interest. I mean, just look at this graph of someone who invests $1,000 per month with an average annual return of 8%. It takes 17 years for their contribution amounts to equal the amount that they've earned in compounded gains. This is why it's so darn important to get as much money invested as soon as possible so that the money can start working for you. If you invest money and continue to check it for the next 5 years, then the progress is going to look so small, which can be really frustrating. But always remind yourself that you're not investing for a 5 or 10-year payoff. You're investing for that 20+ year payoff. Another thing to remember is that our results are a lagging indicator of what we did in the past. Think about your financial situation right now. Where you're at and what you do or don't have is a lagging indicator of the combined actions that you've taken in your life up until this point. So think about what you want your financial life to look like in 15 or 20 years and work backwards to what you need to do between now and then to make it happen. Because this point in time right now is going to be that future lagging indicator. It's a lot easier than you think for the average investor to lose $1 million. The financial industry is full of professionals that just want to take money away from you bit by bit without you even noticing. A company like Edward Jones just wants to charge you a 2% fee to let them manage your money for you. It's that simple. I mean, 2% doesn't even sound too bad, right? Heck, they don't even say it's a full 2%. They break it down among a ton of different expenses to make it seem even more acceptable. They're going to maybe charge you a small 0.25% for a sales load fee on everything they buy for you. Another 0.25% as a redemption fee when they sell investments for you. Another 0.50% for the expense ratio because each of the funds that they have you invested in need to be paid. And because they're managing your money every year, they're going to charge you 1%. All totaling 2%. But if you were someone who invested $10,000 per year at an average annual return of 8% for 40 years, then you'd be paying a little over $1.1 million in fees. You, of course, wouldn't notice how much you were paying in fees because no money is actually coming out of your bank account. This isn't like when you go pay for a coffee and have to hand over money that you have. It's coming out of the returns from your investment account, which is a lot more difficult to quantify as time goes on. On screen, I'll show a quick guide so that you can understand how much different fees will reduce your portfolio's value by, so when you see any investment fee out there, then you can be reminded of how much in value it's really going to cost you. Something like an Edward Jones charging 2% would reduce the value of your investment account by 55%. Half of your hard-earned money just disappears. Fees always have and will continue to always matter. Do not let anyone try to convince you otherwise. Very, very, very few high-fee investment opportunities are actually worth it. So when it comes time to work with a financial planner or advisor, if that is what you choose to do at some point in the future, always go with one that is a true fiduciary who charges an hourly fee. Yeah, they might seem expensive on the surface since some of them charge between $200 and $500 per hour. But when you compare it to the ones who charge you an ongoing 2% fee, that hourly rate seems like a bargain compared to paying over $1.1 million in fees. You would have to work with an hourly financial advisor charging $200 per hour for 5,500 hours to ever even come close to paying them $1.1 million in fees. I put together a special investing playlist for you, which you can check out to your left next. Down in the description below are more resources and playlists to help with all of your personal finance and investing needs. I'll see you in the next one, friends. Done.